Section 5. The Wise Use of Credit. Appropriate use of credit. At some point in our lives, almost everyone uses consumer credit. Credit means buying now and paying later, using goods and services while paying for them, or borrowing cash and repaying it in the future. Credit also means becoming indebted to someone else. You have to pay back the debt. Remember, when you use credit, you are promising to pay back the amount of money you borrow, plus the finance and other charges. Pay back the debt, regardless of any personal crisis or unexpected situation you later face. Make payments on time. Keep any item that has been used as security for the debt until all payments have been made. Give back what you are buying or give up whatever is used as security if you cannot finish paying off the debt. Take responsibility for the loss of value of the item you bought on credit if it has lost value and has to be returned to the creditor. Credit has both advantages and disadvantages. The advantages of credit include: you get to use the purchase while you pay for it. You can buy things that are needed when you don't have enough money on hand to pay for them. Credit can be helpful in financial emergencies, such as when you have unexpected major medical costs, a death in the family, or need to replace or have major repairs made on appliances or automobiles. Credit is convenient. You do not have to carry a lot of money around with you. Credit helps to make expensive items easier to purchase. Using credit wisely helps build a good credit history, which can be important for getting credit in the future. You may be able to save money by taking advantage of special bargains or sales when you don't have enough money with you. The disadvantages of credit include: purchases cost more when using credit. Interest and other charges are added to the purchase price of goods and services. Credit ties up future income. When you use credit, you owe money that must be paid back from income you haven't yet earned. By committing to monthly credit payments, you have to give up other things that you need in the future. It also may be more difficult to deal with unexpected events and emergencies, such as layoffs or illnesses. Credit can encourage overspending. You may buy more than you can pay for, and may even buy things you don't want or need. If poorly managed, credit can lead to major financial problems. Deciding to use credit. Whether or not you use credit is a decision that requires careful thought. Using credit creates a financial obligation that can affect your family's future. So whenever you are considering using credit, ask yourself these questions. Is it worth the extra cost to have the item now? Is this something I really want? Is this something I had planned to buy? Is it related to my financial goals? Can I make the payments? Have I been realistic in estimating my other expenses? Will I want to be paying for this for the length of the credit agreement? Will the payments force me to use or limit my contributions to savings that have been set aside to meet my financial goals or build my emergency fund? Can I afford to tie up my future income? What if I get sick or have an accident? Do I want to risk repossession, a bad credit history, or legal action if I cannot repay the debt? Would it be wiser to save money and buy this later? Am I borrowing from a fair and honest lender? Do I understand what the contract says? Alternatives to credit use. The primary alternative to relying on credit for purchases is savings. Below is an overview of alternative methods of payment, all of which use your existing money. Cash only. Cash only. This is the simplest way to pay for things locally. It is also the best way for you to know how much money you have, how much you can spend. If you tend to be an impulse buyer, Leave the credit card at home and carry only your daily allowance with you in the form of cash. Checking account. Checks are accepted widely and can be used for purchases through the mail. Furthermore, many online merchants now allow you to use your bank account information to pay. Where people get into trouble with check writing is that they neglect to balance their checkbook and thus do not know how much money they have left to spend. You should be meticulous in recording every transaction in your checkbook and immediately calculating your current balance. Debit cards. Debit cards are a type of payment card that offers a safe, convenient alternative to cash and checks. Debit cards allow you to access your bank accounts anywhere by using an ATM. Debit cards can be used in two ways, as an ATM card and as a payment card. When you use it as an ATM card, a debit card allows you to withdraw money directly from your checking or savings account. Access to the account is restricted by a personal identification number, PIN. When you use a debit card as a payment card, you can use it to make purchases at a wide variety of merchants. The purchase amount is deducted directly from your bank account, so there are no interest charges. As with checking accounts, you need to know your current balance before you spend. You will also need to decide whether you want your bank to provide overdraft protection for your card. Having overdraft protection means that a purchase transaction will go through even if you don't have the money in your account, but you will have to pay a hefty penalty for each individual transaction that is an overdraft. It is best to decline overdraft protection and be careful about your spending. Prepaid, reloadable debit cards. Prepaid cards are ideal ways to enforce spending limits. There is no credit involved with these cards. They are basically prepaid debit type cards. Load them up with money, and it is used like a debit or credit card. Once the funds are depleted, the cards can be reloaded with more money. Secured credit cards. A secured credit card is a credit card used to build a good credit record for people with a damaged or poor credit score or for people with little or no credit history. A secured credit card requires a security deposit in order to be able to establish a line of credit. Typically, the line of credit you qualify for will be equal to the amount of money deposited with the bank or financial institution that issued the secured card. When you spend with the card, you are not using the funds deposited. You are actually spending on a line of credit based on the amount you have deposited. So, you still need to make a payment on the balance. And you will face interest charges if you do not pay off the entire balance each month. Many secured cards charge fees for opening the account and then charge fees for accessing your funds. In some situations, a prepaid debit card with a credit builder option may be a less expensive way to build credit. Secured credit cards are also referred to as prepaid credit. Let's review some different types of loans. Secured versus unsecured loans. Secured loans are loans that use one of your assets, such as a home or car, as collateral to guarantee that the lending institution will get the amount of the loan back, even if you fail to make payments. Examples of secured loans include home equity loans or car loans. Because these loans are backed by collateral, they usually have lower interest rates. However, if you fail to make your payments, the asset used as collateral, such as your home or car, will be seized by the lending institution. Unsecured loans, such as credit cards, do not involve any collateral and therefore present a higher risk to the lender. For this reason, unsecured loans usually carry higher interest rates. Most unsecured loans are dischargeable in bankruptcy. Fixed rate versus variable rate loans. The majority of consumer loans are fixed rate loans. These loans maintain the same interest rate for the duration of the loan. Normally, lenders charge higher interest rates up front for fixed-rate loans than they do for variable-rate loans. This is because lenders can lose money if market interest rates increase and the loan rate remains lower than the current market interest rate. Variable-rate loans have an interest rate that is adjusted at different intervals over the life of the loan. There is usually a maximum interest rate that can be charged on the loan, or a cap, as well as a maximum that the interest rate can increase each year. The interest rates on these loans may change monthly, semi-annually, or annually. The interest rate is adjusted based on an index, such as the prime rate or the 6-month Treasury bill, as well as on an interest rate spread. Lenders usually charge a lower interest rate up front for variable rate loans because the lender will not lose money if the overall market interest rates increase. Cash loans. Cash loans are often used to obtain goods and services that are expensive or to meet emergencies. This type of credit may be obtained from commercial banks, savings and loan associations, credit unions, consumer finance or loan companies, or even life insurance companies. Other sources of cash loans, which can be very expensive and should be avoided, include pawn shops and those offering payday loans. Cash loans generally are payable in one lump sum or installments. Installment loans. Installment loans are loans that are repaid at regular intervals, for example, every month. Each payment includes part of the principal and some interest. An installment loan amortizes over the length of the loan, which means that with each monthly payment you make, more of your payment goes toward paying off the principal and less goes toward paying for interest. The amount of interest that you pay each month is calculated based on simple interest. Installment loans are typically used to finance purchases of houses, cars, appliances, and other expensive items. There are a number of special types of consumer loans, loans that are different from traditional consumer loans. These include home equity loans, student loans, and automobile loans. Home equity loans. Home equity loans are also known as second mortgages. In a second mortgage, you use the equity in your house to secure the loan. The benefits of a home equity loan are that you can usually borrow up to 80% of the equity in your home, and the interest payments may be tax deductible. With this type of loan, you can also get a lower interest rate because the house is secure. It can't be moved. One disadvantage of this type of loan is that it limits your future financial flexibility because you can only have one outstanding home equity loan at a time. Moreover, a home equity loan puts your home at risk. If you default on a home equity loan, you can lose not just your credit score, but your home as well. Apply for a home equity loan through a bank or credit union first. These loans are likely to cost less than those offered by finance companies. Home equity lines of credit. Home equity lines of credit are basically second mortgages that use the equity in your home to secure your loan. These are generally adjustable rate notes that have an interest-only payment, at least in the first few years of the note. Generally, interest rates are variable and payments cover only interest in the first few years. These have lower rates of interest than other consumer loans. The benefit of these loans is that the interest may be tax deductible, reducing the cost of borrowing. These loans sacrifice future financial flexibility and put your home at risk if you default. Automobile loans. An automobile loan is a consumer loan that is secured by the automobile that the loan is paying for. This type of loan usually has a term of 2 to 6 years. The advantage of an automobile loan is that it usually charges a lower interest rate than an unsecured loan. The disadvantage is you must make interest payments, and since vehicles depreciate quickly, you are often left with a vehicle that is worth less than what you owe on the loan you got to purchase the vehicle. Another special type of loan is a student loan. Student loans can be federal government loans or private student loans. In general, you should try to take out only federal government student loans and avoid private student loans. U.S. Department of Education federal student loans are referred to as direct loans, and examples include Stafford loans, Perkins loans, and PLUS loans. Some federal student loans have special advantages, such as subsidized interest payments and lower interest rates. Also, you can defer payment of federal direct loans and Stafford loans until 6 months after you graduate or discontinue full-time enrollment. Although federal student loans are not dischargeable in bankruptcy, you can apply for an income contingent repayment plan that limits your monthly payments to a reasonable amount. Income contingent repayment is currently available only from the U.S. Department of Education, not from banks or other private institutions making government-guaranteed loans through the Federal Family Education Loan Program. But if you have one or more FFEL loans, the Department of Education will allow you to consolidate your loan or loans into a federal direct consolidation loan so that you can elect income contingent repayment. Although private student loans have some advantages, such as more flexibility in how you use the money, they are much riskier than federal student loans, especially because they carry higher interest rates that can increase and because they do not offer the type of income contingent repayment plans that federal student loans have. Be very hesitant before you take out a private student loan. Private student loans cannot be discharged in bankruptcy. Some types of loans are best avoided. Payday and tax refund loans. Payday loans are illegal in some states. Recent changes in the law for payday lenders have also made payday loans illegal for members of the military. With a typical payday loan, you might write a personal check for $115 to borrow $100 for 2 weeks until payday. The annual percentage rate, APR, in this example is 390%. If you can repay the loan quickly, it may not appear such a bad deal. But if you can't pay off the loan quickly, that relatively small loan can grow into a large amount of debt. At 390%, a $100 loan will become $490 in a year and $2,401 in 2 years. Another high-cost way to borrow money is a tax refund loan. This type of credit lets you get an advance on a tax refund for a fee. APRs as high as 774% have been reported. If you are short of cash, avoid both of these loans by asking for more time to pay a bill or seeking a traditional loan. Even a cash advance on your credit card may cost less. Rent to own. Rent to own is one way to get furniture and appliances for your home if you don't have money to pay the full price of the item in cash. Rent to own is a purchase contract with fairly small weekly or monthly payment plans. Rent to own might be right for you if you only want to use furniture and appliances for a few weeks or months. However, rent to own is a very expensive way to furnish your apartment or home. Avoid rent to own. Policies at rent to own stores vary, but you will pay a great deal more to own the item than the price for a similar item if purchased from a department or discount store. Rent to own items also may be used items. The following is a good example of the bad deal you are getting with rent to own. You rent a 19-inch color TV, the value of which is $300 new. You pay $16 per week for 52 weeks, which adds up to $832. Given that the value of the TV was only $300, you just paid $532 in interest, which is a 254% annual interest rate. In addition, you may have purchased a used TV, which is not even worth $300, only $150. Avoid rent to own. Another problem with rent to own happens when you can't keep up the payments. If you miss even one payment, the item can be repossessed. You will then lose the benefit of any payments you have made toward owning the property. Many people have paid more than $1,000 for property worth less than $500, only to lose that property for missing one payment. If you need to buy furniture, appliances, or electronic goods, and you can't immediately afford them, you should look at options besides rent to own. The best option may be to save money, if at all possible, and then pay cash. Consider selling something you don't need to buy something you do. Don't assume that you will not qualify for more conventional credit. Stores may grant credit even to people with a bad credit record, or they may have other ways for you to purchase at a reasonable rate of interest. Check whether the store has a layaway policy that might work for you. Before you sign an agreement for a loan to buy a house, a car, or other large purchase, make sure you fully understand all the lender's terms and conditions, including the dollar amount you are borrowing, the payment amounts and when they are due, the total finance charge, including all interest and fees you must pay to get the loan, the annual percentage rate, APR, the rate of interest you will pay over the full term of the loan, penalties for late payments, what the lender will do if you can't pay back the loan, penalties if you pay the loan back early. The Truth in Lending Act requires lenders to give you this information so you can compare different offers. Comparing credit card offers. Chances are you've received pre-approved credit card offers in the mail. Examine the fine print carefully before you accept any offer for a credit or charge card. Here is a typical printout of the information you receive with credit card offers. Over the course of the following pages, we will examine each of the items individually. The first row of information you see is the annual percentage rate for purchases. This is the interest rate you pay on an annual basis if you carry over balances on purchases from one billing period to the next. If the card has an introductory rate, you will also see the rate that applies after the introductory rate ends. Multiple interest rates may be listed here. Your rate will depend on your credit card worthiness, which is based on your debt, income, credit score, and other factors, such as your history of paying bills on time. Next, you see the annual percentage rate, or APR, for balance transfers. This is the interest rate you pay on an annual basis if you transfer a balance from another card. Balance transfer fees may apply even if the balance transfer APR is 0%. If there is an introductory rate, pay attention to when that rate ends and what the new rate should be. Third, you see the APR for cash advances. This is the interest rate you pay if you withdraw a cash advance from your credit card account. Cash advance fees may also apply. You will see these fees later. Most credit card companies charge interest immediately, starting from the date you get the cash advance. Your credit card company may increase your interest rate for several reasons, which are listed here under the Penalty APR and When It Applies section. Be sure to read the terms and conditions of your card to know what can cause your interest rate to go up. If you trigger the penalty rate, your credit card company must tell you that they will be raising your rate 45 days in advance of the increase. This section also tells you how long the penalty APR will apply. You might have to ask your credit card company to lower the rates. Credit card companies might not automatically remove the penalty rate. Minimum interest charge. Credit card companies often have a minimum interest amount. These charges typically range from 50 cents to $2 per month. Even if you carry over a low balance, you can be charged a minimum amount of interest. If the minimum interest charge is $1 or less, the credit card company does not need to disclose that charge here. So far, we have been looking at the various kinds of interest that credit card companies can charge. Now we turn to fees. Setup and maintenance fees. Some credit cards offered to people with lower or subprime credit scores may charge a variety of fees, listed here. Some of these fees are charged before the card is used and may reduce the total amount of credit initially available. Transaction fees. Credit card companies may charge you a fee for transferring a balance, getting a cash advance, or making a transaction in a foreign country. These fees can either be a fixed dollar amount or a percentage of the transaction amount. If you are planning to transfer a balance, get a cash advance, or make foreign transactions, check your agreement for these fees. Penalty fees. Credit card companies may charge you a fee if you pay your bill late. Some companies may charge different fees depending on your balance. The higher the balance, the higher the fee. If you have consented to extensions of credit that exceed your credit limit, you will be charged a fee if a transaction takes you over your limit. If you made a payment but did not have sufficient money in your bank account to cover it, credit card companies may charge you a fee, just like a bounced check fee. Other fees. Some cards require credit insurance, debt cancellation, or debt suspension coverage. These fees may be called account protection or something similar. Descriptions of balance calculation methods. The method used to calculate your balance can make a big difference in the interest charges you will pay. Adjusted balance. The outstanding balance at the beginning of your billing cycle minus payments and credits made during the billing cycle. Average daily balance, including new purchases. The sum of the outstanding balances for every day in the billing cycle, including new purchases and deducting payments and credits, divided by the number of days in the billing cycle. Previous balance. The balance is the balance at the beginning of the billing cycle. Loss of introductory APR. If your card has a special lower rate that is called an introductory rate, this area will list the ways in which you can lose this lower rate. For the first year after opening an account, you can only lose an introductory rate if your account becomes more than 60 days past due. When you apply for credit, the potential creditor will want to know if you are creditworthy. In other words, the creditor wants to know if you are willing and able to repay the debt. To determine your creditworthiness, a creditor usually looks at 3 factors. Capacity. This refers to your current and future ability to pay. Do you have a steady job? How long have you been employed? What is your income? How much credit are you already committed to? What are your other expenses? Capital. What do you own, or what are you purchasing that could be used to guarantee the debt? Even if you don't have to put up collateral to guarantee the loan, creditors usually prefer that you have assets other than just your income, such as savings, investments, or property that could be used to repay the debt. Character. This refers to your willingness to repay the debt. How trustworthy are you? In the past, how prompt have you been in paying your debts, rent, and utility bills? Is your credit history good? Creditors use these and other factors, such as the state of the economy, when reaching their decision. Some set higher standards than others. Some simply do not offer certain kinds of credit. Different creditors may reach different conclusions based on the same set of facts about you. One creditor may find you an acceptable risk, while another may deny you the credit you request. Some common reasons for being denied credit include too much outstanding debt, too little time in current job or at current address, unreasonable purpose for requesting credit, cosigner cannot take on additional debt, errors on credit report, strict creditor standards. If you have borrowed before and have a good repayment history, you have some information to help convince a creditor that you are a good credit risk. What if you have never borrowed, or if you have a poor record of credit repayment in the past? Then you need to begin to build or rebuild a good credit record. One of the best ways to establish or reestablish a good credit history is to provide evidence of financial responsibility. You can do this in several ways, such as by opening and managing wisely a checking or savings account, paying bills on time, getting and managing wisely a local retail or department store credit card or charge card, getting a small installment or cash loan and paying it back promptly, having someone co-sign a loan with you and guarantee to repay the debt if you don't. Don't apply for too much credit at the same time, since this may be a warning sign to a potential creditor. In addition, having credit denied or having repayment problems will stay on your credit record for a period of time, generally 7 years, and may make it difficult to get credit in the future. Many people use some type of credit, but using too much credit can lead to financial problems. Below are some warning signals to look for. You pay only the minimum amount due on your credit cards each month. The total amount you owe on your credit cards does not shrink from one month to the next because of new credit purchases. You take out new loans to pay off old ones. You skip payments. You rely on the overdraft protection feature on your checking account. You charge day-to-day expenses like food and toiletries instead of paying cash. You get notices or phone calls about past due bills. You rely on extra income from overtime to make ends meet. You use savings to pay current bills. Not counting your mortgage, your credit payments are 20% or more of your take-home income. You borrow money to pay occasional expenses like insurance and taxes. You are late in making payments each month. You are turned down for credit because you have a poor credit record or too much debt. Checking your credit report. If you've ever applied for a credit card, a personal loan, or insurance, there's probably a file of information about you somewhere. The file will include information such as where you work and live, how you pay your bills, and whether you've been sued, arrested, or filed for bankruptcy. Companies that gather and sell this information are called consumer reporting agencies, or CRAs. The most common type of CRA is a credit bureau. CRAs sell this information, your credit report, to creditors, employers, insurers, and other businesses that have a legitimate reason to get the information. The CRAs do not make the decision to grant you credit or not. They simply provide the information to potential creditors. Creditors decide whether or not to grant credit according to their own standards, using a variety of information, including that provided by CRAs. What is in your credit report? Consumer reporting agencies collect 4 basic types of information. 1. Identification and employment information. Your name, birth date, social security number, employer, and spouse's name are routinely included. The credit bureau also may provide information about your employment history, home ownership, income, and previous addresses. 2. Payment history. Your accounts with different creditors are listed, showing how much credit has been provided and whether you've paid on time. If an overdue account was turned over to a collection agency, this also may be listed. 3. Inquiries. Credit bureaus maintain a record of those creditors who have asked for your credit history within the past year, as well as a record of those who have requested your credit history for employment purposes for the past 2 years. 4. Public record information. Events that are a matter of public record, such as bankruptcies, foreclosures, or tax liens, also may appear in your report. Most information stays in your credit report for 7 years. There are certain exceptions, however. Information about lawsuits or unpaid judgments against you can be reported for 7 years or until the statute of limitations runs out, whichever is longer. In general, the statute of limitations refers to the period of time during which legal action can be taken to establish the claim and collect on the judgment. Bankruptcy information may be reported for 10 years. Some information can be reported indefinitely. For example, there is no time limit for reporting information about criminal convictions. When you apply for a job with a salary of $75,000 or more, when you apply for life insurance with a face amount of $150,000 or more, or when you apply for credit in the amount of $150,000 or more. Time, a conscientious effort to repay your debts, and a pattern of financial responsibility is the only remedy for improving negative but accurate information in your credit report. Companies that promise to clean up your credit report, for a fee of course, can't do anything for you that you can't do for yourself. Fraudulent credit repair companies may even collect their fees and vanish without providing any assistance at all. It is a good idea to check with your state's Consumer Protection Division of the Attorney General's office about the credit repair company before purchasing this service. Obtaining your free credit reports. The Fair Credit Reporting Act requires each of the nationwide consumer reporting companies, Equifax, Experian, and TransUnion to provide you with a free copy of your credit report at your request once every 12 months. The three nationwide consumer reporting companies have set up a central website, a toll-free telephone number, and a mailing address through which you can order your free annual report. To order, visit www.annualcreditreport.com or call 1-877-322-8228 and order the Annual Credit Report Request Form and mail it to Annual Credit Report Request Service, P.O. Box 105281, Atlanta, Georgia 30348-5281. Do not contact the three nationwide consumer reporting companies individually. They are providing free annual credit reports only through the centralized website, phone number, and address. You may order your reports from each of the three nationwide consumer reporting companies at the same time, or you can order your report from each company one at a time. The law allows you to order one free copy of your report from each of the nationwide consumer reporting companies every 12 months. You need to provide your name, address, Social Security number, and date of birth. If you have moved in the last 2 years, you may have to provide your previous address. To maintain the security of your file, each nationwide consumer reporting company may ask you for some information that only you would know, like the amount of your monthly mortgage payment. Each company may ask you for different information because the information each has in your file may come from different sources. A warning about imposter websites. Only one website is authorized to fill orders for the free annual credit report you are entitled to under law: www.annualcreditreport.com. Other websites that claim to offer free credit reports, free credit scores, or free credit monitoring are not part of the legally mandated free annual credit report program. In some cases, the free product comes with strings attached. For example, some sites sign you up for a supposedly free service that converts to one you have to pay for after a trial period. If you don't cancel during the trial period, you may be unwittingly agreeing to let the company start charging fees to your credit card. Checking your credit rating. The information in your credit report is used to calculate your FICO score, a number generally between 300 and 850. The higher your score, the less risk you pose to creditors. A high score, for example, makes it easier for you to obtain a loan, rent an apartment, or lower your insurance rate. Your FICO score is available from www.myfico.com for a fee. Free credit reports do not contain your credit score, but you can purchase your credit score when you request your free annual credit report through www.annualcreditreport.com. Perhaps nearly as important as the score itself are the factors that pull the score down. Along with the score, the bureaus have to provide the top 4 factors that most affected the score. If the number of inquiries to a consumer's report pulled down the score, the bureau must disclose that too. This information is critical because knowing what goes into the score will help you figure out whether there is anything you can do to improve your score. The section code for this section is 156.